is considered very prominently, but environmental social issues remain to get that kind of prominence. There is also a regulatory vacuum. So ESG is not mandated for unlisted state utilities, and also the state regulators have not ventured properly into integrating ESG into the current existing regulations, or there is not even a proper debate around it uh, in a way. Uh, Also, the reporting boundaries have been messy. So the way utilities after the uh, reforms have been restructured, the boundaries have become messy. There are holding companies within the states which have the administrative control, and then there are utilities which multiple utilities within a single state with doing responsible for different functions in different areas, which makes I mean the exact and a lot of things are overlapped because these were earlier singular massive state electricity boards. So that kind of legacy still plays on. So which makes it difficult. I mean, in terms of reporting boundaries, when we venture into ESG reporting. The value chain is also for intermediaries like DISCOM is also difficult. I mean, the determining the value chain and accounting for it is also difficult. So it's a uh, it's a challenge that remains. The regulatory incentives aren't aligned. So electricity regulators, as I said earlier, they primarily focus on optimizing tariffs and affordability. So there is a need to come up with more regulatory incentives which can incentivize discoms for such reporting. And finally, discoms are a very routine-oriented entities, which and unless ESG practices are embedded in these routines, it's very difficult for discoms to actually take ESG issues seriously and transform themselves through ESG. So we are basically trying to see discoms ESG as a kind of a transformative tool, or offering an alternative narrative uh, for uh, uh, for discom reforms. So I mean, what is the way forward? Uh, so way forward would include, I mean, creating a DISCOM specific ESG guidance. So adapting global frameworks to Indian realities and clarifying the reporting boundaries and the value chain scope. Designing KPIs which actually reflect uh, what's happening within the DISCOMs, the efforts towards RE enablement, loss reduction, resilience, upgrades, etc., are not captured in the generic frameworks like BRSR and other frameworks like GRI and all. And even when certain frameworks like SASB and GRI capture certain sector specific bits, but they are more aligned to the Western context, not the Indian context. For example, they have for them the definition of affordable electricity is 500 units. In India, 500 units I mean, it is not it does not fall into that affordable power bracket. Also, aligning regulations with regulatory processes with easy disclosure targets to close this enforcement gap is important. Uh, Building capacity and institutionalizing routines. So embedding ESG in everyday workflows is very important, which can be paired with incentives to the ground staff, and also kicking off to pilot ESG reports with few discoms to test the metrics, data systems, and assurance, and use the learnings to catalyze collaborations among discoms. Like the Gujarat thing that we are doing might catalyze further uh, engagement into this area, and more discoms might be interested in this as we engage in this. Also, raising public and stakeholder awareness is also important. So there is an external pull for better disclosure and performance. So it's not just discoms are doing it for compliance, but there is also a pull from other stakeholders the stakeholders that DISCOM is dealing with. Then it has to be also clubbed with creation of financial products which are tailored to DISCOMs that incentivize ESG disclosures. So we'll uh, we kind of propose creating a virtuous cycle where there are these regulatory and financial incentives which trigger which incentivize ESG adoption and disclosure by DISCOMs, which then creates certain marginal changes and make equitable green and financially and operationally efficient DISCOMs, which then further incentivizes the financiers and regulators to offer further incentives. So this cycle kind of has to be triggered in some manner, and we hope that through our initiative uh, we take this narrative we'll take this narrative forward, and and more and more, and we'll see more and more adoption by the DISCOMs in the coming years. So thank you so much. This is the link for the report where all the participants can download and share amongst their colleagues, and we would be happy to receive feedbacks about the report. Uh, Thank you. So I'll maybe next I'll start with uh, the panel discussion. So I'll just ask first my co-author Tirthankar to add on to something if I have missed something.
No, and just you have covered like the main point. One, just another, maybe as I would just pick up the last part, like since we have already this multiplicity of different frameworks, different guidelines and all for not just not specific to the utilities, but the utilities are in a situation whereby they are kind of trying to fit themselves up in the context of this established framework, and within that what the study the reason is actually lie in the motivation for this is actually twofold. One is that what we understood from the various conversations, not just on the ESG specificity but on other issues as well, that getting more sources of identifying and accessing new sources of finance is a key challenge to both the public and the private utilities. And that is possibly why they are more and more, the utilities are more and more inclined to kind of get on with this ESG bus, I would say. The second is that even with the most advanced one, or even with the very much industry focus, utility focused frameworks and sustainability guidelines reporting like the IFRS and others, which have been kind of came into being after much debate in 2023. They also just focus on hugely on scope 1 and a little bit on the resilience part, that too from the transmission side. Not exactly what a utility, the way we understand in our country, the utility functions. And there are so many types of potentially reporting elements that can be showcased or at least kind of acknowledged as part of utility work. I think that is where we currently stand, and we are all in the journey of exploring how we actually better it. It is this report, this paper is not, it's just the identification of the issues and then where do we move from here. So that is where we would love to hear from all of you as experts in this field to actually shape up this work in the future. I stop over here. Abhinav, over to you.
Yeah, thank you, Tirthankar. I would like to first introduce our esteemed panelists. So I start with Professor Anish Sugathan. Professor Anish is a professor at IIM Ahmedabad. He is also a co-chairperson of the Google ESG Center for Research and Innovation, and also he is on the board of as an independent director in UGVCL, which is Uttar Gujarat Vidyut Company Limited, which is a discom for North Gujarat. Uh, Welcome, sir. Uh, Dr. We have with us Dr. Sanjay Verma, who has more than 24 years of experience in power sector, and he has been part of Haryana Electricity Regulatory Commission as Director Tariff earlier, and he is an experienced hand in the regulatory and tariff related matters, and we'd love to hear from him uh, in his perspective around this issue. And he was also one of our reviewers in this publication. We have Sonali Gokhale with us, who is a research associate at Prayas. Welcome, Sonali. Sonali works on the issues pertaining to RE and RE finance and public interest. And Sonali has a deep experience around the issues of finance and and the public. How the public issues related to it. So we would love to have her input in this. She is also one of our reviewers for this publication. Next, we have Smita Hari with us. Welcome, Smita. Smita Hari is president at Octus Global ESG, Octus ESG Global, and Smita is a finance professional with 19 years of experience in corporate and entrepreneurial experience, and she has an experience in sustainable finance, ESG, investment banking, and impact investment. So, welcome, Smita. We'd love to hear your perspective around finance and ESG. So, thank you. I'll start with maybe Professor Sugathan Pekin. So, I mean, from a governance and institutional reform perspective, uh, how do you think ESG frameworks address the deep structural and operational issues that plague the Indian discoms? And yeah, maybe your reflections overall on this whole issue around that this whole thing around ESG for discoms, this initiative. Yeah, you can start with that, and then also uh, uh, give me your reflections on how ESG frameworks address the deep structural and operational issues plaguing the discoms.
So, thank you so much, Abhinav and Tirthankar, for coming together and authoring this report. And thank you, um, WRI, for organizing this webinar. And thank you for hosting me. Thank you so much. It's a very sort of, I think it's an age-old question. The problems plaguing DISCOM is actually the number one issue which keeps coming up, whether you talk about public finances, central level, state level, whenever we talk about any kind of reforms in the sector, invariably the financial performance of DISCOMs comes up, the governance issues, operational difficulties faced by these DISCOMs come up as a main criteria. Now, even before we get into sort of ESG as a framework which can sort of talk to or address some of these issues, it's important to understand the complex and lay of the land. DISCOMs, after the deregulation, that is breaking up of utilities, they operate with a very specific mandate, and even the report I was reading through, the private DISCOMs that you have tabulated, all of them are also integrated. I mean, they have a GenCom arm, yeah, they have a DISCOM, and some of them even have transmission capabilities, which means that and they have presented an integrated report. But if I want to isolate, and only look at the DISCOM operation, I see a different kind of a view on what are their ESG issues. I would specifically say that it's important to understand that from a legacy perspective, when we talk about financial viability, it's partly because of the areas in which they are mandated as a public utility to operate. And you cannot talk about financial profitability as a term without taking into account the cost of provisioning, the unit cost of provisioning, and what kind of subsidy is accounted for by the government to take into account the gap, the viability gap, the cost of provisioning and the actual tariff which they are. Because DISCOMS is heavily regulated, like you mentioned, it's a national monopoly. You have territorial monopoly, therefore its tariff is capped. The only mode of then governance reform pretty much starts focusing on operational efficiency, which is both commercial losses as well as technical losses. And I think it's important to take the spotlight away from financial profitability for a lot of, especially state-owned DISCOMs, and start focusing on technical and commercial losses, and focus more on efficiency. So if ESG frameworks, first of all, I would say the ESG frameworks as it exists don't really apply to DISCOMs in any direct way. But if there is a possibility of reimagining and reinventing that framework, we should start focusing on some of those real metrics, not financial profitability. So there is a possibility to sort of do that, and I think that is an opportunity. As regulated entities, unless it is part of the regulation, it is unlikely to be identified, recorded, or even acted upon. So it's a good conversation to have. What could those variables be?
Thank you, sir, for echoing our point on there is a need for reimagination of the current frameworks, which is we also argue through this issue brief. Next, I'll come to Dr. Sanjay Verma. Sir, are you there? Yeah.
Yeah, thank you.
Yeah. So from your long experience of being part of the State Electricity Regulatory Commission, do you think ESG principles have or will become necessary for Indian DISCOMs in the future? And how do you see ESG helping them move beyond short-term financial compliance to long-term institutional credibility and public trust? Can ESG, help them in this?
Yeah, thank you. As widely understood, the power sector, that means generation, transmission, distribution, they contribute roughly 75% to the CO2 carbon emission. Hence, this segment is very important from the ESG point of view, or containing the carbon emission. Now, what actually happens, as rightly pointed out by you, from voluntary disclosures, the SEBI, the market regulators, they introduced mandatory regulation so that the corporates can comply. But this is applicable only to the publicly listed company, which is traded in the bourses. Now, what is happening in the power sector, especially the distribution business? DISCOMS, as rightly said, is a regulated business. It is a licensed business. Nobody can distribute power without a license issued to them under Section 14 of the Act by the Regulatory Commission. Now, this Regulatory Commission is also a creature of law. Hence, they cannot do anything which is not mandated in the law. And what is the law? The Electricity Act 2003 is the law, and some of the states, they also have their own act. But as long as they're consistent with the Central Act, it exists. If not in line with the Central Act, then the Central Act prevails. These regulators, they frame a regulation which is a delegated law. I think the electricity regulators are the only entity which can frame law. So this is what they call it, delegated legislation under section, I think, 182 of the Act. Now, there are 30, 40 items mentioned in the Act on which the regulators can frame regulations. Beyond that, if they try to frame, say, something on ESG or something, try to make it obligatory or mandatory for the DISCOMs, uh, it will be bad in the eyes of law if challenged. It can be challenged. It can be taken up for judicial review in the High Court. The High Court will remove it. They will simply say you are a creature of law. Which law says that you will legislate or frame regulation on this? Now, what is happening now? In 2020 and also 2022, amendment to Electricity Act was introduced. Somehow it could not go further. Now, again in 2025, there is an effort to amend the Act. What this Act does, this Act removes the clause which says that you cannot get a distribution license unless you own a distribution network, a parallel distribution system. Now, this is not only time consuming, but capital intensive as well. Then there is a clause, universal supply obligation. Then they have mandated for reduction in cross subsidy surcharge and additional surcharge. And also they have said that tariff should be cost reflective. What is happening today in most of the states? Why most? Almost all of states, there's a gap between average cost of supply, ACS, minus ARR, average revenue realized. So the DISCOMs, they incur loss on each unit of sales that they undertake. Now the amendment mandates that ACS ARR gap has to be removed. Next good step, which also endorsed by the Honorable Supreme Court, it says that you should amortize the regulatory assets. In states like Delhi, there will be 20,000 crore regulatory asset. In Andhra Pradesh, it will be more than 70, 80,000 crore. This basically means that the DISCOMs there have not been given the benefit of building this revenue recognized by the regulator into tariff. Therefore, viability of the DISCOMs itself becomes doubtful. Now, a consensus that has emerged that these things should be taken care of. Once this is taken care of, other than the big companies that you mentioned, Adani or Goenka, CSE, Tata Power, Lanco, etc., there'll be many smaller players that will enter the fray. They will not abide by any other thing unless there's a mandate given to them by the regulators, by the regulatory commission that look here, you have to undertake these kind of activities to say promote environmental aspects. I mean, earlier there was a mandate given by the MOP for FGD, flue gas desulfurization. What happened to that?
Yeah.
Timeline got kept extending. Finally, it has been forgotten and kept in the cold storage.
So we get your point. What you are pointing out is that ESG is kind of a natural extension to the regulatory goals like improving service quality and accountability, consumer protection. It all encompasses certain parameters within the ESG framework also.
It does. But,
Yeah.
but as you rightly said, that there has to be some incentive. Suppose you can build in the incentive. Who will do it?
Yeah.
Regulators will do it. If there is a 14% return on equity, give them 0.5% more if they comply with these regulations.
Yeah.
Build it into standard of performance. If they don't do it, then there is a penalty for them. So by doing all sorts of incentive penalty regime, one could promote ESGs. And this area will open up in a huge manner because of the amendment that is sought to be brought about in the law itself. Thank you.
Thank you so much, sir. Now I come to Sonali. So as rightly said by Dr. Sanjay Verma, that the amendments and future reforms will kind of open this area in a huge manner. So, I mean, could ESG be a new narrative of transparency, good governance, and responsible enterprise that Indian electricity sector needs badly? And how might this narrative shift citizens' trust and policy expectations around DISCOMs?
Thank you, Abhinav, for that question. To answer your question, I would predicate it that this, the quality of the question doesn't really depend on whether the amendments come into play. I think overall for the electricity sector, especially for distribution utilities, state-owned ones, where they have been mired in multiple financial problems, and there have been multiple bailouts to try and sort of streamline some of their issues and lighten some of the burdens, and structurally try to respond to some of the intractable issues. In any case, any transparency building exercise or any opacity reduction sort of measures for Indian distribution utilities is a welcome step, because I believe that there are a lot of areas where, not necessarily out of design, but I think by default or by legacy inertia from the time of the unbundling, etc., there is a lot of data, or there is a lot of areas which need light to be thrown on it. And if, like Dr. Verma was mentioning, if there is a thrust from regulator to say that this is part of something that will improve your transparency, I think that would be a net positive. Having said that, from the trust building perspective, or from other, I mean, you mentioned in one of your responses or remarks that attracting different types of finance or attracting financiers also could be one of the fallouts. I think in that context, I believe that one should temper one's expectations, at least given the state where we are in today. And the reason why I say that is that I think a lot of the realities of what you're trying to showcase through the ESG tool, even a reimagined one, as Professor Sagathan was mentioning, I think some of those value factors that state-owned DISCOMs drive, in the hitherto regime, not with the amendments discussed before this, where, all sorts of players will enter the fray and competition, etc. I think the value of society, the societal value, and, the last mile value and the connectivity value, and all of those, I think, are fairly understood. The reason for the financiers to stay away or to balk at, let's say, responding to certain needs is because the issues in the distribution sector in Indian electricity are intractable and sort of interconnected and difficult to resolve, also have a lot of legacy burden. So from that perspective, I think if we right size our expectations, it could become, as you're saying, the start of a good virtuous cycle to improve transparency and to bring in that sort of a culture, or just sort of a temperature of standardized and well tabulated data about lot of areas of operations, including their asset size, including what has been their capex plan, and rollout of other schemes. That there have been a lot of schemes that have come for strengthening of the net worth, etc. Where all of those, transparency enhancement is always great, but yeah, right sizing expectations is equally critical.
Thank you, Sonali, for this. So, I mean, as you pointed out, the finance angle to it. So we have our finance expert Smita here. So Smita, from your experience with ESG finance, what signals investors and financiers are looking for from the Indian utilities? And because we have seen, I mean, there are institutions like municipalities, metro projects. They have raised money through green bonds and social bonds. Can DISCOMs follow a similar path, and how will ESG reporting help them to do that?
Thanks, Abhinav. Thanks to WRI for inviting us on this panel, and I think a lot of very valid points have already been mentioned by the earlier experts who've spoken, and Abhinav, even in the report which you have shared. Just a couple of things. So maybe I'll bucket the questions for what the question you're asking. I'll break it up. So in terms of what investors are looking at. See, generally when a financial investor comes to make an investment, or even a bank for lending, the risk return profiles need to make sense from a financial lens. So ESG is just a layer on top of that. despite there being ESG focused funds or climate focused funds and things like that, the main goal for any investor is, like all of us agree, it's to look at the from a financial perspective, do the risk return models make sense? So that we all know that DISCOMs have a multitude layering of challenges or even barriers which are being trying to overcome. So assuming that that is on one side, if we look at what specifically from an ESG lens investors are looking at, governance, I think, would rank very important. And Sonali has put out very clearly on that point. So in terms of transparency, governance, so even if there are disclosures on certain metrics, then how much of assurance is built into that, right? So how much of validity and credibility is associated with those disclosures. So I think just reporting or disclosing is by itself not an end game, but building that trust and confidence is something which will be very important from an investor perspective. Then when you look at, so Abhinav, you did speak about material, issues in terms of what is relevant to the DISCOM. So also looking how much of these are actually aligned to certain, established standards. Like I think the report that, does talk about SASB, right, where material issues, risks, and opportunities are covered. So from a DISCOM perspective, when we identify material issues, are they aligned to international standards, especially when you're looking at international capital? That becomes quite important. And somebody did mention about how there are a lot of different disclosure standards and frameworks. So it's like an alphabet soup of disclosures, which not just DISCOMs, I mean, even a big corporate kind of gets lost in that big myriad of disclosures. And now that is kind of getting consolidated for IFRS S1 and S2 from a disclosure perspective. So I think it's not important on how many or what all are we covering, but it's more the intent to show that there is credibility and it's aligning with certain established parameters. And even if we look at, like you did mention about green bonds, right? So there are international, like ICMA, the International Capital Market Association, puts out certain principles for green bond issuance. So, aligning with that, aligning to how the use of proceeds are actually going towards green. These are some things which can, which will be looked up by investors. So robust governance, assured data, ESG data, standardized KPIs, basically, to look at from a transparency perspective. These are some things which can move towards building that investor confidence, assuming that the risk return profiles are also, sorted. Yeah.
Yeah, thank you, Smita, for this answer. So then I move again to Professor Sugathan. So basically, from the issue of, like, everyone in the panel has highlighted how, and our report also highlights the challenges around DISCOMs adopting these ESG standards and frameworks. So you also sit on a DISCOM board, and so I mean, you might be knowing how things work inside, in where at the decision making level. So what are the internal capacity and data challenges that make ESG reporting difficult for the government run utility, not essentially DISCOMs, all the government run utilities? And can there be certain governance innovations or incentives that can make what can make this ESG reporting more credible and not just a paper exercise? Because in many, government organizations, you see that compliance a lot of these things are just taken for compliance and then forgotten. How do we make it last and more credible in certain way? Yeah. So.
Thank you, Abhinav. We'll just continue to build upon the narrative which the esteemed other panelists were talking about. I will first and foremost point out, like Mr. Verma was also saying, that we are dealing with the regulated entities, and when we're talking about regulated entities, the first and foremost focus of the board or the leadership is to ensure compliance. And more the regulated entity is, more the bandwidth of the leadership is focused on compliance. So if you are, let's say, in the banking sector, I mean, most of the time you simply think about, if there are any sort of compliance violations. So, being a regulated entity, if I want a certain, set of additional parameters to be brought under a performance regime, which can then be subjected to any kind of incentive, disincentive, mechanism, it has to be clearly spelled out. So especially for the state, DISCOMs and utilities. The second part is, I believe there is kind of a ambiguity around and confusion around the term ESG. All three of these letters, environmental, social, and governance, we just put them together. Like in the, secondary high school, we have PCM, physics, chemistry, math, and we combine together and we showcase like a aggregate score, right? So it is important that maybe some of these things are not relevant to a sector like DISCOM. I mean, take a simple example of, let's say the DISCOM itself. I'm just talking from my experience serving. Oh, by the way, I've completed my term, so I don't currently serve on the same board. But is that the core idea should be enabling transparency, which is where I would also agree with key. And then the question is, key, what is not transparent already in a public utility, which can be, which if it were to be made, transparent, if it were disclosed, that would sort of, make the DISCOMs more aligned with the, larger societal goals. If I just open up any public utility, I mean, pretty much all numbers are out there. For anybody to, and as a regulated company, a lot of, I mean, pretty much everything is, except maybe for some of the cost numbers, which again, it's a proprietary, and I know there are competitive factors that come in. So it is important, I feel, first of all, to sort of understand key, within ESG, what is it that is relevant from a DISCOM perspective? Is it carbon? Is it, let's say, bribery and corruption, which will fall under governance, or is it sort of, the way employees are treated, which will be probably fall under, the social aspect. And that, depending upon our reimagination of this, what is an appropriate ESG compact framework, relevant for a utility, the data systems will have to be changed. The current data system, as I said, is geared towards compliance. It is geared towards checkbox activity, and there is no other incentive from any other angle. Now, you should also sort of distinguish between public utilities and private utilities, where on one side there is, let's say the private, there is disciplining coming from the market forces. On the other side, there are mandates coming from the investors. Like Smita was talking about it, if I am a utility and I want to, let's say, expand upon a coal project, I will have to make my ESG disclosures and, to seek, let's say, international syndicate loan. It's not easy to get if I am expanding with very high ESG score. But then there, the ESG is focusing specifically on carbon footprint, not other things. The focus would be entirely on, or pretty much entirely on, carbon footprint. But look at the DISCOM part of it. Okay, DISCOM, maybe it's useful to take an analogy. I mean, when you think of electrons moving, we can't see them, we can't hear them, we don't know what is going back and forth. But imagine DISCOM as a logistics company, a fleet of trucks carrying goods from the GenCom and, sorry, from the transmission to some extent, let's say the GenCom end to the consumer end. Now, I want to reduce the carbon footprint of the logistics operator, the trucking fleet. So what is relevant for me? I'll say, oh, you can change the fleet's fuel mix, you can change it to EV or something. Right? But can I say that I should also penalize you depending upon what kind of cargo are you carrying? So if the trucking fleet is carrying coal, would I count that as carbon on the trucking fleets, which is scope 3? But it is not even scope 3 because it's whether I carry brown electron or green electron. So I have to reimagine that. Probably technical losses is something which I can focus on, which makes direct sense on efficiency. Second is on the disclosure front, you see that a lot of the technical losses and commercial losses gets mixed up a little bit. Partly because of there are pilferages, there are theft, and all those things happen. So that is an area where disclosure would be welcome. And so if we sort of realign ESG along what is specifically applicable to the value chain, if it's a GenCom, I understand it makes sense to talk about CO2. Transcom and Discom, I need to talk something else that would be in spirit aligned with ESG. Yeah, so that would be my.
Yeah, thank you, sir, for that elaborate response. So coming to Dr. Verma again, so I would just like to know, I mean, continuing from your last answer, that how can I mean, because there has been a recent tariff order in Gujarat where they have directed the state utilities to submit their ESG disclosures, but we don't know the antecedent of how that directive came about. Uh, but in that context, I mean, how does state commission begin to embed ESG principles into their processes, regulations? I mean, like Gujarat has tried it through maybe a tariff order. We are yet to know about its antecedents, but I mean the SOPs, the reporting formats. So what support, and also what support do regulators need to build this capacity around ESG evaluation, the technical trainings, and shared guidelines? So from a regulatory perspective, I would like to know.
Actually, the state commission, they have huge powers. Now, coming to Gujarat, I've not seen the order, what they could have relied upon is a preamble to the Electricity Act 2003 only, where they say that it is a responsibility of the regulators to see that the business is carried on in an efficient manner. Now, efficiency is what? These things are efficiencies. Therefore, secondly, tariff design or tariff order is in the exclusive domain of the state regulators. Now they can design a tariff and inbuilt something for this CGS as well. So they can. Now, when it comes to funding it, they have to propose with justification, with say some sort of a cost benefit analysis. It could be a simple CBA, it could be a social cost benefit analysis. Like in some of the states, they have this regulation called demand side management or demand flexibility. Now, for shifting peak load to off peak load, it brings down the cost of power drastically, because at the peak, power may cost 8 rupees, 10 rupees. On an average, it may cost 3.5 to 4 rupees, maximum 5 rupees. So if you cut the peak and fill the valley, you have lots of cost saving. So these are the manners in which they have to justify why they want to incur these kind of costs. So but the first thing, as far as publicly owned DISCOMs are concerned, and most of them are publicly owned, except Odisha, one in West Bengal, Mumbai, one or two in UP. Most of them are publicly owned. So these DISCOMs, they are not under any pressure to show financial gains or whatever. But they need, and they are very meticulous. They go by the rule book, A, B, C, D, E, F. They have to comply, tick, 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 C, D. They don't look beyond that. So why should they? Because there's no incentive involved with it. So Gujarat Commission and rest of the Commission can take on themselves to have a comprehensive disclosure norms. But the issue which I have faced is benchmarking. Even after 20 years, we have not been able to benchmark because the tariff design is what? RPI minus X. X is the efficiency factor, the K factor. We have not been able to arrive at a benchmark from where to build. So in this case also, there has to be some benchmark, maybe by the regulators, maybe by the Ministry of Power, etc. Secondly, the Ministry of Power, they conduct these ranking. Once in a while, I've seen this rank A plus, so on and so forth. In that ranking, if you see the breakup, these kind of things, they don't figure. So why don't you put it there? If the ranking improves, if the cost of capital to them declines, it will be very much a win-win situation, both for the private entity as well as public entity. Yeah, that's it. Thank you.
Yeah. Thank you, sir, for echoing our point also on the rankings and ratings. So we'll be following up. We have been trying to following up with PFC and REC, which release these rankings to actually expand their parameters and also include some of the ESG. Maybe that can trigger more ESG. Also trigger that kind of reimagination. So if not at the state level, it can be triggered from the central level in some manner. So I come to Sonali next. Do you see the case of making ESG disclosures mandatory under the state level regulations like the Gujarat ESG directive, and also how can regulators and civil society co-create, come together and what is the role of civil society in play a role in transparent public facing ESG metrics that to make DISCOMS more accountable and transparent?
Right. So I'll answer the first question. It's a difficult question to answer. And the reason is that every state in India has got very unique characteristics. The consumer mix is different, the demographics are different, the quality of the connections and what are the political pressures, etc., are all very unique. So in electricity sector, what I've learned is that there is very rarely a one size fits all sort of approach. It's never a good idea. Has to go step by step. Now, in the case of Gujarat, I think it is widely understood from those of us who have been studying the sector through various lenses that they seem to have, done a much, what can one say, successful sort of foray, or they've kept that standard of operating, whether it's efficiency, whether it's financing, whether it's power procurement policy, whether it's tariff design. I think they've been able to manage the show. I think one of the best in the country generally is understood. Anyone who studies the sector knows this. Having said that, there are other states where the situation is very different. And for a good reason as well, not necessarily only misdemeanor or poor planning. It's a lot to do with legacy issues. It's a lot to do with the consumer mix, the demographic of that state, where it's positioned in the economic growth rate, or what would one call economic index, and so many multiple factors. So perhaps for a state like Gujarat and the quality of the DISCOMS being where they are, this is a good starting step towards not only transparency enhancement, but also to start seeing whether there is some interest in raising innovative financing instruments to expand their scope, etc. Having said that, other states, because I said, Dr. Verma also mentioned that there are states where the regulatory assets are stupendous. The cleanup of that, and the management of all those losses, taking those over, ironing them out, ensuring they don't happen again. Those are much higher priorities in most of the states, I would say, which are beleaguered for a long time. So perhaps for those states, where the basics need to be figured out, or essentially the steady state functioning needs to mature to a certain degree through either efficiency drives, or it's through capacity building, or it's through strengthening of certain infrastructures, or it's through designing some innovative schemes so that tariffs become more sustainable, given the complex demographic makeup. Perhaps those states, ESG, introduction at this stage at least, given where we are, I don't think that will add. It'll probably, even if it is, let's say, set up as a mandatory requirement, the pushback could be quite a bit. Having said that, also, it could just become a tick box exercise and not really add anything as far as, enhancing transparency or shining light on inefficient areas is concerned. So it's a difficult question to answer. I think Gujarat is primed for this kind of thing, and maybe we'll wait and watch how it plays out. So that would be my response to the first question. And the second question, as far as how does general society, as we call it, or consumers, how do they ensure that DISCOMs can be held more accountable? I think, so I have a background in banking and finance. I've been a career banker for a very long time before I pivoted to Prayas. And I know for a fact that financial sector regulators do not have that much of an active public process, unlike the electricity sector, which is, I think, one of the most, I think it's a hallmark characteristic. And I think public processes are fairly robust, and there is a lot of active participation from individuals who've been tracking the sector for a long time. Maharashtra, for example, has got a very vibrant public process, a lot of participation from CSOs and so on. I think if that is itself an available sort of platform for people to engage more deeply with that, I think would be an excellent beginning. ESG and the rest of the mechanisms are finally a via media or a classification tool to reorganize information, I think. But as far as engagement is concerned, I think engagement actively in public processes, and also for our community, where we are think tanks and academicians, for us to be able to demystify some of those concepts, demystify certain changes or litigations that are happening, change in law related large legal issues that keep cropping up from time to time. I think it is our duty also morally and professionally to demystify as much as possible, so that that information and what changes and how it impacts me as a consumer, how it impacts me as an industrial consumer or as a retail consumer in an urban setting, or just somebody who's running a business, a small entrepreneur, demystification and thereby less gatekeeping on electricity sector. That way is it's a complex sector with a lot of technical things, and demystification, I think, and participation in public processes, I think, would be a fantastic step up in terms of accountability. And I think it'll also bring in that element of vibrancy, a depth to public processes where there are a lot more voices, there are a lot more elements of, what can one say, impact, which typically is concentrated to far and few sort of players today. If there are more voices with more delineated impact of what a particular order is trying to do, and if people do it more frequently, they'll be able to understand, I believe, and engage in a more meaningful manner. So I believe more than modality introduction at this juncture, given the state of many states, no pun intended, I think these two would be really good. I think we can do a much better job as academics to demystify and, as far as possible, the alphabet soup that Smita was mentioning, thin it out so that people can sort of digest it.
Thank you, Sonali. So coming back to Smita, I mean, speaking of the incentives, I mean, like I try to show, I mean, can there be a virtuous cycle around finance, ESG disclosures, and DISCOM improvement? So what role do you see for the financial institutions to trigger this cycle? I mean, what kind of incentives or capacity building uh, uh, can the institutions play, the role financial institutions can play, and what would it take to trigger this virtuous cycle uh, from a financial incentives perspective? What kind, I mean, the instruments, from the financial instruments, the financial uh, 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 the financial leverage that institutions have. How do we, I mean, uh, can you throw some light on?
Sure. Thanks, Abhinav. So I think before I answer your question, I saw a question on the chat box. If
Okay.
there are financial incentives available for ESG KPIs, right? So I just wanted to address that before I answer your question. So, see, there are different types of financing instruments, and I'm not talking specifically to DISCOMs. Generally, I'm talking about which have a sustainability or an ESG element, and not all of them link the KPIs or the performance of the KPIs to the pricing in the financial world parlance pricing or even incentives, right? So it's more to, so there are instruments like sustainability linked instruments, wherein the interest rate one pays on the financial product. So if it's a loan, the interest rate one pays on the loan is linked to how the ESG metrics are achieved, or sustainability metrics or KPIs are achieved, which are predetermined. So when the instrument structure has that in place, and there are instruments like sustainability linked loans or sustainability linked bonds or outcome based instruments, these kind of instruments, then their financial incentives or rather the pricing is kind of changed based on the achievement of that. So that's just to address that query. So coming back to your question on creating the virtuous cycle and how ESG reporting can actually help. So as has been told a lot in this session, so transparent ESG disclosures by utilities, it fosters comparability, credibility, investor trust, and things like that, right? So one unique thing about this particular sector, if I may, is that unlike the S and G buckets, social and governance buckets, which are more sector agnostic. So it like, for example, gender diversity, worker safety, training. It's not just unique to DISCOMs. It can be across different sectors. The E element, the electricity, the environment element is one needs to be very sure on what that entails. Like I think how Professor Sugatan was also mentioning. So there was this the Asian Utilities Engagement Program that was basically, I thought it's interesting to bring it up. It was launched by the Asia Investor Group on Climate Change, I think 3 or 4 years back, basically to look at how climate engagement with Asian utility companies can be kind of promoted. And while it's not unique to DISCOMs, it also has generation transmission companies. It was interesting to note that how the utilities with a better reporting are incentivized, and how there is a penalty on the opposite. So if there are gaps or if those preset commitments are not met, then there is a penalty for that. So there were some examples in terms of how like in the China Light and Power Holdings, I think there was some commitment there, and how they had actually helped in kind of getting that metric onboarded. So successful investments generate measurable outcomes that which can further kind of look at strengthening accountability, disclosure, credibility, and things like that. And there is also an element of how and we've seen that mostly in integrated utilities, not specifically to DISCOMs, but how when there is transparent reporting, there is a way to kind of look at diversifying your pool of investors, so to say. So you're basically increasing the scope of your investors. And it's not just a regulatory compliance, it's also when it becomes a business case. So when it's a mode of, reducing your risks, so better transparency and things like that. So it becomes more of a business case than a compliance or a tick box exercise. And that's when you can actually look at how it can be like a a virtuous loop. So Tata Power, for example, I think your report also mentions that. And because it's a big company, because there are investor pressures or even regulatory pressures for disclosures, they have disclosed under a whole lot of disclosure standards. So BRSR, obviously, they are mandated to disclose their ESG metrics under BRSR. But in addition to that, they have done an integrated report. They have looked at climate related reporting and these kind of different aspects. And particularly the Tata Power Mumbai distribution, they signed a PPA for a particular, I think, 80 megawatt of renewable energy. So basically, there's an integration of clean power directly into its urban distribution portfolio. So these are like smaller elements. And while the goal may not be kind of to look at how directly to look at how capital can be mobilized because of this, for Tata Power, for example. But they are just going on to kind of see that some of these metrics can actually be disclosed, which can help in getting financing for it. On your question on how financial institutions can actually help DISCOMs kind of start off on this journey. So I think, see, you're right. So like when financial institutions actually start considering ESG or climate related aspects in their core lending models, and maybe I'll talk about it a little later when we talk specifically on financial institutions. But I think the engagement between the financier and the entity getting the financing. So it could be either a bank and a borrower, or an investor and an investee, whatever the type of, like in a debt instrument or an equity instrument. I think that engagement needs to be very strong. And that's where, because we see a lot of gaps when you talk of ESG or sustainability in general, again, not specific to DISCOMs, even for like industries where there are proven examples of this, there is still a lot of gap, not just within the borrowers, but also in banks itself, to assess ESG metrics, or to look at how these can actually be translated into conventional risk frameworks. So capacity building becomes very important in this case, and having a robust engagement model, the bank borrower engagement model, so to say. And that can also sort a lot of the challenges you had highlighted in your presentation, Abhinav, when you say that data is a challenge, or reporting becomes a challenge, or identifying the right metrics, these kind of things. And that is where, like Sonali was mentioning, think tanks or academia can come in to kind of build these capacities and boost the system. So maybe I'll take a pause here. We'll talk about.
Yeah, thank you, Smita. So I come back to Professor Sugathan again, and there are also questions flashing in the Q&A box. If the participants can parallelly also see that, we'll come to them after a bit. Professor Sugathan, how, can the next phase of distribution reforms embed ESG thinking from the outset? So like we are already, talking of this Electricity Act amendment, which is trying to trigger those kind of reforms. And does ESG have a potential to offer this new narrative for the sector? Yeah, your take.
So Abhinav, I would, it's useful to think of, the genesis of ESG. You just mentioned about, the UN background where it came up. See, one of the reasons why the ESG as a concept evolved was, primarily focusing on the private sector, was that from a perspective of improving transparency and visibility into non-financial but material metrics. Okay, so items which would matter for a company, both in terms of risk and opportunity, but are not visible because they are not measured, they are not reported. So it's not visible to an investor, it's not visible to the customer, right? So in that sense, the true risk and return potential of the underlying asset is not it's not correct. So ESG was then, as a voluntary disclosure mechanism, or as a, disclosure system, was to bring some of these non-financials, which are not yet in the P&L system, to be fully disclosed, so that I can make an informed choice, right? So if you are, if there is carbon on your in your production system, I should be able to sort of discount it or whatever. I should know what is the risk of being in this sector and so on and so forth. Or if I have a preference as an investor, I should be able to do that. Now, with that as a cornerstone of ESG, when I think of distribution reforms, the next stage of distribution reforms, I would say that for the private entities, private utilities, where, like I said, there is already visibility and discipline coming from both the investor side, and the customer side, because there is a competition to some extent. But for the state-led utilities, I believe more clarity. If ESG could bring out more transparency on elements like which is not disclosed yet, but is material. For instance, as I was saying, that the extent of pilferage which happens, inefficiencies which are usually bucketed together into one big loss. But if you could open that up, it's helpful to find out how many disadvantaged areas where electricity is required, but the cost of provisioning is very high, and yet the DISCOM is providing. Disaggregating that and disclosing that would also enable policymakers to understand what are the sources of these financial troubles. So if the next set of reforms could somehow make the source of the financial troubles of every single DISCOM more transparent, more visible, I think that would be the biggest sort of value add of incorporating ESG. As I said, not in the current format, but in a format that is relevant to the utility.
Thank you, sir.
Thank you.
So we have some audience question also. I mean, the questions from participants. So one of the question by Rishika, she asked that from your experience, do DISCOMs view upcoming carbon markets as a viable avenue for enhancing their revenues? Given the REC did not translate into substantial revenue generation, to what extent could ESG disclosures help DISCOM unlock new revenue opportunities? If someone from the panel can take it.
I would say it will have only a moderate impact specifically on DISCOMs. But if you take it as a utility, GenCom specifically, that is where I believe the largest opportunities are, because the footprint, scope 1 footprint is directly over there. DISCOM, it will be very limited, as I understand the economics and technology of that sector.
Actually, there are two things involved here. One is experience with REC market. Why the REC market failed? And prior to it, the CDM market. CDM market failed because of the international developments. Why the REC market failed? REC market failed, or the green tag trading, it failed because of non-compliance in the states. Different DISCOMs, especially the publicly owned DISCOMs, they could never meet the target, and they never cared to meet the target. Therefore, the demand for RECs were much lesser. And for almost 1.5 to 2 years, market was inoperative because of the tussle between the IXPX and SEBI, the regulators. Who would govern, who would take care of these? Ultimately, it was resolved. But now, given the interest that at least I see in Haryana and must be in other states also, especially from the PSUs. I mean, there are quite a few PSUs who came to me. One of them was Maruti Udyog Limited, who said that I want 100% green power. Now, if that is the stand taken by the PSUs, and especially the central PSUs, then things should move on, and the market and the revenue that it generates would improve. I mean, then reforms, of course, will have to come into play, where there is a heavy penalty proposed for non-compliance of the RPOs and CPOs also now. Yes.
Yeah, thank you. Smita, I have one question for you regarding, I mean, as we have heard from the panelists that DISCOMs have a different kind of a mandate. I mean, even before the reforms, post their restructuring also. So they have a very strong social mandate, which is attached to the nature of the service they provide. How do financial institutions look into this this nature of DISCOMs, where they have a very strong social mandate? And that's how, I mean, a lot of financial troubles which DISCOMs have are overlooked because of, I mean, but how does financial sector uh, treat them, this kind of thing?
Yeah, maybe I'll take a step back, in terms of, when financial institutions start considering ESG or climate to dur hai, but it's quite away, but even if you talk of ESG in their core lending models, then that can eventually get translated to borrowers, right? So if you're talking of banks, then or NBFCs like PFC and REC. In fact, if you look at specifically on PFC and REC, because they finance a lot of DISCOMs, embedding ESG parameters in their evaluations, in their loan appraisals, will eventually mean that DISCOMs will, I mean, maybe it won't be called ESG in that sense, but for example, PFC, they have released their annual standalone ESG report. So basically, they're on what is covered under environmental or social or governance performance. There are aspects like carbon reduction, renewable energy financing, these kind of things. They also have a green bond framework. Similarly, even REC, they have a board approved ESG policy, basically guiding investments, operations, due diligence, specifically prioritizing financing for renewable energy, energy efficiency, these kind of things. They also had some Sustainability Icons Award they won recently. So, I just wanted to say that these two being the large lenders for, DISCOMs, they have already started looking at these aspects. And even if it's not very aggressive, at least they have a board approved policy. They have so the general checks and balances have started falling in place. RBI also, in fact, has recently last year came up with draft guidelines for banks, for regulated entities, upper layer NBFCs, on how they will have to start reporting on climate related risks and opportunities. On the other side, the market regulator, SEBI's BRSR has already started mandating value chain disclosures. So, when you talk of, the entities, it's more like it's in a phased manner. But again, large banks who come under this BRSR core requirements, they will start asking these details from borrowers. Now, all this, what I was just telling you, it means that financial institutions will start embedding ESG considerations into their overall risk management frameworks sooner or later. But it will happen, right? Even if it's in a phased manner. And that will include how loans are sanctioned or how portfolios are monitored. And existing templates, therefore, there could be, parameters like, loss reduction or grid modernization, consumer grievance metrics under the S of ESG, all that. Having said that, these concepts are nascent. Like I told you earlier, a lot of capacity building efforts are required. And a good starting point can be to examine where existing activities of DISCOMs already are under this green or social bucket. So there may be a lot of existing activities which can be tagged as ESG, but it is not being captured or it's not actually being marked under that. So again, like I told you, having an engagement with, from a financial institution perspective, having an engagement with the borrowers will need to be redefined so it will not just be on financial metrics. It could also be on these other non-financial aspects, need not be called ESG, but it could cover some of these other metrics. So before I stop, one example which, I thought may be of interest, of course, it is from a developed market. So this was a loan which EIB, the European Investment Bank, had given to this distribution network called e-Distribuzone. And basically it was a 250 million euro kind of a loan. And that was to strengthen climate resilience and digitalization of the power grid in Italy. And it was a sustainability linked loan. So as I was speaking about that a little earlier, basically on achievement of certain KPIs like GHG emissions, not directly relevant to DISCOMs, but even looking at, social metrics, the pricing of the loan was, it could either go up or it could go down. So it could either be incentivized or penalized. So for Indian DISCOMs, a similar top-down ESG integration in performance evaluations by financial institutions is something which can, be a part of the regular monitoring which can, happen.
Yeah, thank you, Smita. I mean, I understand it's also about the visibility of the initiative uh, in some way. Like if there is an RE project, solar power project, it gets an immediate visibility that yeah, immediate green outcomes which accrue from it. But if a DISCOM installs smart meters, the accrual of the outcomes is not that visible in a manner. I mean, the DISCOM reforms, the because DISCOM is the ultimate. I mean, the the lowest end of the whole energy transition, and so whatever upstream transition we do, unless the DISCOMs are efficient, unless the DISCOMs are financially viable, uh, the transition will not translate into actual results. They will not be able to procure that whole upstream power which is being generated through greener sources. So this thank you for highlighting this. Yeah. Uh, Tirthankar, would you like to come in here?
No, I just wanted to fairly good, very interesting points actually elaborated through our esteemed panelists. One of the things that I wanted to reiterate is that, and there are interesting questions in the chat box as well. But one thing, as Smita was suggesting, um, ESG actually falls in a very at the interface of actually meeting your carbon related, emission related goals, as well as some of the actions which bring in more efficiency in the DISCOM operation, and which is quite a new or a very kind of sensitive topic to actually chart in from the financial, from the investor's perspective. I think those two are the minimum requirement to actually get something, because we need to understand that why an investor is actually asking for these kind of benchmarks or these kind of reporting guidelines. One of the reason is that give and take any kind of, even if it is a Genco or something, or say any other entities which is an RE developer, investment to energy sector of any kind is a highly risky proposition. And if you see developed and developing country actual cost of investment, and so in our part of the world, we are actually it is twice as costly as compared to the developing world, in terms of if you take dollar values or any other kind of values of those particular investment types. And that is why these are kind of markers which try to kind of address some of the investment risk, and to get a sense that my money that I am putting in, that doesn't go for a toss. So I think one of the basic tenets, as Professor Sugatan was mentioning, that some of the issues in terms of financing problems, because the way DISCOMs are structured in our country, they have a social service, like social obligations to fulfill as part of the societal norms and regulations, as well as they have to do their own business as well. So we cannot actually ask a DISCOM to not provide electricity and like provide lesser amount of electricity, because that will affect their revenue system. So that's a very tricky situation, while it has to also comply with all other things. So that makes it a very risky proposition for any of the investors to consider, specifically when it has a large amount of like these kind of unrecovered units. Like it doesn't recover the total units that it is providing at cost. Right. So that is where the whole things comes up, and that these are all proxies which will make the DISCOM operation more efficient. But as said, power sector doesn't operate in, say, DISCOM or transmission or a GENCO separately. They have to take the whole of it. And that is why the reforms or the next steps actually lie in. And yes, those are the issues that we will be kind of interested to take forward in the coming days.
Yeah, thank you, Tirthankar. So I think we are coming in the last few minutes of this webinar. So I would like to, call on the panelists for any last words that you might. So Deepak, yeah,
Yeah,
please.
Abhinav, Mr. Muralidhar Rao in the Q&A has spoken about wanting to talk about an equitable PPP model. So to the extent that links to ESG intervention, the topic of the webinar, I would like to request if he can maybe give us a 3-4 minute intervention. If you're there, Mr. Rao.
Yeah, please, Mr. Rao. Sir, you're not audible, please.
Hello.
Yeah, please.
Yes, sir. We can hear you.
Yeah. My name is Muralidhar Rao. I have been in the electrical industry from long. I was a major supplier to the transformer industry. You name it all, BHEL, Crompton Greaves, Alstom, everybody. And I was a member of the EMA, I was a member of the CIA. And when each of those times I was a major supplier to all of them, the biggest problem all of them faced was they were supplying to the electricity boards, which even today are bankrupt. Okay, and they in turn will pass on the burden to me. So and I had been campaigning through EMAS, CII for privatization of distribution. I knew where exactly the problem was. Finally, when in Delhi it happened, and Sheila Dikshit's time, and somebody was talking about pilferage. Yes, the pilferage at that time, T&D losses, theft and dacoity losses, okay, was something in the range of about 55%. It is down to 8%, which is on par with the best in the world. And if you take any of the parameters, we talked about so many of them, apart from ESG, it's been a transformation of Tata PDDL particularly. I have a tabulation, I put it on my blog site. It's all there, and I've been tweeting, and many people have been finally. And with the Karnataka government not taking cognizance of it, in spite of so many of the representations I made to them at various levels, finally I went to the court and I argued in person. And talking about ESG specifically, I live in an apartment complex where I was the first association president. And I'm an engineer, I made the calculation. We consume something like about 230 liters of diesel every month on gensets. Extrapolating across the city, the domestic sector alone, it will work out 11 million liters of diesel every year. It is like something like, say, from our, I don't know if you're familiar with Bangalore, some silk boat to Attibale, 10,000 tankers lined up. Oh, that is the kind of diesel we are blowing up. Whereas in cities like Mumbai, Delhi now, you don't need a liter of diesel for that. So I brought this up before the Chief Justice. And all the other points also I countered. There were 4 respondent lawyers from the state, from the Karnataka Electricity Regulatory Commission, Karnataka government, and Pollution Control Board. I brought Pollution Control Board into this picture because of this particular aspect. They couldn't counter any of my arguments. Finally, the Chief Justice said that what else do you have to say? And he said, yeah. I pointed out to him. I mean, this is the state responded lawyer. He made a point at the fag end, saying that this is not a judicial matter. It is for the state legislature to decide. Your Honor, I concede that point. In your state, he's Justice Ankaria, who is now gone on to the Supreme Court. In his state, in his city, Ahmedabad, it is Torrent Power, which is a private sector company which is supplying power. So, and we in Bangalore are supplying the vagaries of the poor supply by BESCOM, a government-owned company. He smiled, but finally, when the order came, order came about 2 months down the line. On, let's see, he said, since I was in the industry, yes, I was in the industry, okay, but I had pulled out of the industry because of the financial problems I faced. That was 20 years back. He said, because you were once in the industry, your PIL, public interest litigation, cannot be seen as a public interest. You have a personal interest. And because of that, I was dismissed. Anyway, I am carrying on. It's all there on my website. And it is the ultimate model. Mind you, I tweet on it. And a gentleman from Lagos in Nigeria tells me that they are now following and they are enjoying excellent power. That's a excellent PPP model, not just for power supply. Similar models can be structured for all areas where government has to have a role. And that is what I would like to submit. Thank you.
Thank you. Thank you, sir. Over to you, Abhinav.
Yeah, thank you. Thank you for all the panelists. So, if you have any last word, please, Professor Sugathan, starting from you.
Nothing in particular. I guess the panelists covered a wide range of issues which are pertinent to the DISCOMS and utilities in general. I believe this is a nice conversation that you have started, and I've seen some nudges coming from MCA for ESG reporting across public sector utilities. So it's probably, that is what the source of this nudge is coming from, even for the utilities. But the idea is to get a sense of what are the sectoral benchmarks, what are the practices people are following and things like that. So it's good that we're starting this conversation, and it will take a couple of iterations, I believe, before an appropriate, I would say, a DISCOM ESG compact could come up, and that could then we could basically talk about what elements of that could be regulated, so that in the sector across public and private sectors, people can start incorporating in a legally correct way, as I would say. Thank you.
Yeah, Dr. Verma. Dr. Verma, are you there?
Just a brief reaction on what Mr. Rao, in his at the end of his submission, talked about PPP model, public-private partnership model. But we have tried this PPP model, and as long as it remains in the SPV stage before it is given out, it is okay. Once that stage is over, that public partnership goes off. The private fellow is left to fend for himself. So now, but the government now is probably of the view that government should come out of the sectors where private investments and private parties can step in. So basically, they're trying to move towards privatization from a monopoly, from monopolistic state like city boards and PSUs. So PPP probably is redundant. Let it be privatized, more efficient managerial capability, more efficient leveraging of domestic as well as international funds. Thank you.
Thank you, sir. Smita, any last words?
Yeah, no, thanks. I think it was a useful conversation and much needed one as well. So just wanted to conclude saying that obviously the benefits of ESG are well known, have been seen in different sectors, different markets, not just from a risk management perspective, but also from an opportunity lens, building transparency, credibility, and therefore capital raise. One must be cognizant of the fact where the sector is and probably, address the challenges inherent and the opportunities which can come out of it. So maybe look at how capacities can be built for this, how it can be done in a phased manner, how size of the DISCOM should also be taken into consideration, and it's not like a one size fits all. So while the intent and the direction is in the right sense way, as in it can go that way, but putting in these lens of making it phased, considering the size and things like that, will result in better adoption than going all out and saying that everybody has to do it. So that needs to be considered.
Thank you, Smita. Coming back to Sonali, any last words?
No, just thank you for this opportunity to be part of this August panel, because I learned a lot from my co-panelists. A lot of interesting questions, good questions, something to take home and think about. Just on on your issue brief, and what kind of conversations that it should spur. I hope that it spurs. Is that number one? The most important thing is that when we are looking at electricity distribution utilities, it is very important to look at them with a slightly zoomed out perspective rather than looking at them of where they are now. If you're able to create a conversation about, not necessarily ESG as a modality being the instrument for that, but that focus to shift onto what are the interlinkages with the issues that they're facing, and how going forward with certain interventions that are being thought about. There is privatization on the table, there is also parallel licensing, there are so many other interventions in terms of regulatory tweaks that are happening. In this context, it's good to have that zoomed out perspective of how some of those legacy issues can be resolved through some of these newer sort of thinking and thought process around that. That is first. And second is overall the point that you have made in the brief, that you can't look at the Indian electricity distribution space with the exact same lens that a financier would look at any other sort of business model, because like all my panelists have mentioned, that they are very uniquely positioned, they're structured in a certain way. And some of the inefficiencies or some of the intractable issues that they have attracted is also because of their positioning in the value chain of, from Genco right down till the last mile consumer. And I will reserve comment on whether it will, take off in a big way, ESG for Indian electricity sector, especially in the format that we understand ESG today. But it's definitely a great conversation starter. So let's hope that the conversation goes in the right direction and we're able to get some
Thank you so
ideas
much.
on the table. Thank you once again.
So Deepak, anything from your side? Or Tirthankar? You are on mute, Tirthankar.
No, I think I just, as a closing remarks, I think 3 points. One is it's not a summary or anything like that, but actually, like, yes, the reforms specific to from the lens of, as Sonali was mentioning, it has to be very uniquely, since it is uniquely positioned, and it is the business of the utilities are very unique in nature. It can't be just the financier's model that has to be incorporated. It has to be both ways. Some middle ground has to be cracked, and may not be, the current ESG is definitely not the way to go, actually. So we might actually, and to some extent, I think the SEBI's new that list of experts and the task force that they are working on, they are actually taking on some of it on that front. And then on linked to that is essentially what Dr. Verma and Professor Sugatan and Smita has also alluded to, is basically we need to explore these new models, and new models not just in the terms of financing but also utility businesses as well, because there are at least 3 or 4 interesting rules that has come up in the last couple of years, which facilitate your green energy adoption. But at the same time, it also creates a lot of opportunities for DISCOM to actually take that as a kind of one more additional way of creating new kind of businesses and new kind of opportunities. And coming back to the last point is that, yes, ESG is not just the environmental markers and financial markers to be showcased, but it is much more larger than that. And that has to be the front and center of this new, or at least the creation of the discussion for that ecosystem, which is more important because it also creates that awareness. I would not say awareness because everybody is aware of it, but actually to map what we know and how we actually leverage that, that is where the discussion is going to happen. And that is exciting phase which we are going to turn on. And also that creates that just as opportunities is also capabilities and capacities of the new form which we might actually see right from the this right from very different elements of the power sector. So I stop over here. And
Yeah, thank you, Tirthankar, and thank you for all the panelists for this thought-provoking discussion, and also kind of echoing some of the arguments that we made in the issue brief, which raises our confidence that yeah, we are treading some right path, and there are also cautions that you mentioned that are in this path, and we'll take forward this conversation in the future with all of you, and would definitely, I mean, we definitely see the value in this conversation in the future, and it may we really wish that it triggers a new narrative for in terms of the DISCOM reforms and the ESG story for, I mean, it and the other such public institutions, public enterprises take I mean some cue from this discussion. So thank you very much for the panelists. We can close, I think.
Thank you.
Thank you.
Thank you,
Thank you
everybody.
very much.
Thank you.
Goodbye.
bye.